Welcome back. Today, we're jumping right into this explainer on the architectures of wealth. You already know finance is literally the world's most lucrative industry, right? Well, today, we're popping the hood. We're going to look directly at the mechanical engines of scale. We are completely bypassing the surface-level numbers to decode exactly how institutional wealth is structured, optimized, and most importantly, compounded.
Okay, let's dive into this. How do finance businesses actually make millions, or honestly, billions? You see, rather than some confusing maze of numbers, the financial sector actually operates on just a few remarkably elegant, high-margin profit engines. In this explainer, we're going to analyze those exact core mechanics of scale and efficiency.
So here's our roadmap for today. First, commercial banking. Second, insurance companies. Third, investment management. Fourth, consulting and fintech. And finally, number 5, your next financial move. Let's get right to it.
Number 1, commercial banking, the bedrock.
Now, what's really interesting about this slide is the core profit engine, the net interest margin, or NIM for short. It's actually a beautifully simple concept. Banks take in your low-yield deposits, right? And then they immediately turn around and deploy that liquidity into much higher-yield debt instruments and commercial loans. That spread, the difference between what they pay you and what they charge borrowers, is the absolute foundational engine of banking. It's this highly efficient machine where your deposited money is seamlessly transformed into massive income-generating assets for the bank.
But, the net interest margin is really just part of the whole equation. Banks systematically monetize basically everyday activity across the financial ecosystem. We're talking account fees, credit cards, international transfers, business financing, the whole shebang. To put the sheer scale of this into perspective, banks regularly pull in literally billions of dollars a year in pure profit strictly from overdraft fees alone. That's billions with a B. Basically, every single movement of capital represents an opportunity for them to capture a fractional but incredibly scalable return.
Let's move to our second pillar and see how this builds. Number 2, insurance companies, the safety net.
So the true profit center of the insurance model goes way beyond just basic risk pooling. It works like this. You pay your regular premiums, and sure, the company covers claims when things go wrong. But the real magic, the real leverage, lies in step 3, investing that massive remaining pool of capital. In the industry, this is famously known as the float. And actually, Warren Buffett built his entire empire on this exact concept. Think about it. Insurers collect your capital up front, they hold on to it, and they generate massive yield by investing that float in the markets, long before those funds are ever actually needed to pay out a claim. It's brilliant.
That brings us to number 3, investment management, wealth multipliers.
These investment firms operate as the true accelerators of the financial world. So the crucial point is how beautifully simple their highly scalable model is, which is driven by AUM, assets under management. You see, management fees completely decouple revenue from labor. Once a fund's core infrastructure is set up, adding another $1 billion in AUM requires almost zero additional overhead. Their revenue just scales linearly with the capital they capture. It guarantees this massive, steady stream of institutional income simply for deploying and maintaining market exposure. The more of your wealth they manage, the more money they make.
Okay, now let's fast forward a bit. Number 4, consulting and fintech, the modern frontier.
So this modern frontier essentially splits into 2 totally distinct paths: high human capital and high technological capital. On the human side, financial consultants basically turn pure knowledge into profit. They monetize their expertise through hourly rates, project fees, or hefty annual retainers by advising growing businesses on complex tax, retirement, and business strategies. And it's an intensely resilient model. Why? Because as the market gets more and more complex, highly specialized guidance goes from being a nice-to-have expense to an absolute, non-negotiable operational necessity.
Then, running completely parallel to that human capital is the absolute technological disruption of FinTech. This is, without a doubt, one of the absolute fastest-growing sectors in the entire financial landscape right now. FinTech companies leverage code to essentially unbundle traditional banking services. They're aggressively attacking high-margin niches, things like mobile banking, online payments, and digital wallets. What they're doing is stripping away all those clunky legacy infrastructure costs of traditional banks to deliver frictionless, hyper-targeted financial utility directly to you, the end user.
And this brilliantly illustrates how modern apps are totally bypassing the old systems. Because fintech operates with practically zero physical footprint, their customer acquisition cost is dramatically lower. This lets them instantly capture microtransactions and digital revenue that traditional banks historically just completely ignored. They use transaction fees, ongoing subscriptions, and premium digital services. A totally wild, surprising example of this dynamic is actually Starbucks. Thanks to the massive unspent balances just sitting on customers' app accounts, which is literally over $1 billion at any given time, Starbucks effectively operates as an unregulated tech bank, utilizing that huge user-funded float. Crazy, right?
Which brings us perfectly to number 5. Your next financial move, empowering your decisions.
At the end of the day, understanding these 5 models empowers much smarter financial choices and, honestly, inspires future business ventures. When you grasp these macro architectures, you stop being just a consumer and you start operating strategically. Whether you're paying a basic bank account fee, an investment management fee, or a monthly software subscription, recognizing how a bank leverages your deposits or how an app monetizes your transactions absolutely changes the game. It allows you to navigate these systems with real intent, optimize your own capital allocation, and maybe, just maybe, spot the next massive market inefficiency yourself.
So I'll leave you with this final provocative question. How are you going to apply this knowledge to your own financial strategy or your next business venture? The architecture of wealth is now fully exposed for you to navigate, leverage, or, hey, even disrupt. Thank you so much for joining me on this explainer today. Keep analyzing those mechanics of scale and absolutely use this knowledge to empower your financial future.